Welcome to The Explainer. Today, we are breaking down the super weird story behind Nuwellis' second quarter earnings report. You know, it's one of those reports that, on paper, looks like an absolute train wreck, but the market's reaction, well, that's where things got really interesting.
Right. Let's just get straight to the heart of it. This is the big question that had everyone scratching their heads. How on earth does a company post numbers this bad and its stock actually goes up? It just doesn't make sense. Unless you start to look a little deeper, past the scary headlines.
And here it is, a real tale of two stories. On the left, you've got the headline numbers that look like a complete nightmare. I mean, a massive loss per share, revenue dropping over 20% year over year. But then you look at the right, and the market barely flinched. The stock ticked up a bit, and trading volume just exploded. Something else was clearly going on.
To really get the scale of that earnings miss, just wrap your head around this. Wall Street was expecting a loss of maybe, less than $1 per share. Instead, Nuwellis reported a loss of over $60 per share. That's not just a miss, that is a spectacular, off-the-charts miss. So, what did the company have to say for itself? What was their official alibi for these terrible numbers? Well, interestingly, they didn't blame themselves or a lack of customer interest. Nope. They pointed the finger at one single outside problem that they insisted was just a temporary hiccup.
So here's what they said. Management claimed that an industry-wide backorder with the sterilization vendor cost them about $400,000 in sales. Basically, they had the products and they had the customers, but they couldn't get them sterilized fast enough to ship them out the door. It was a bottleneck.
And this quote from the CEO is so important. He's not just making an excuse. He's framing it as a challenge that the company has already beaten. The message to Wall Street was crystal clear. Yeah, it was a problem. It hurt. But it's already fixed, so let's move on.
And this timeline really spells out why that message landed so well. The issue popped up late last year. It did its damage in the second quarter, but look, it was completely resolved in July. So by the time they were having this earnings call in August, the whole problem was already in the rearview mirror.
But let's be real. A temporary supply glitch doesn't fully explain why investors were so patient. The real story, the one that people were actually paying attention to, was that Nuwellis is in the middle of a massive, radical overhaul of its entire business. So the company made three huge, decisive moves to completely change its shape. First, they're getting out of all international business. Second, they're handing off all their manufacturing to another company. And third, they scrapped a big clinical trial to free up cash.
And these weren't just random cost-cutting measures. There was a clear strategy here. The whole point is to become a much leaner, simpler company, focused only on the US market, where they think they have the best shot at winning. It's a huge gamble that getting smaller will actually make them stronger.
Okay, so all of that restructuring set the stage for the company's biggest ace in the hole. This is the real reason investors are willing to wait and see. It's the core of the bull case for Nuwellis, and it's a potential game changer.
The big opportunity comes down to this thing called CMS reimbursement. All it means is it's the amount of money the government, through Medicare and Medicaid, pays a hospital for using a medical device. In this case, Nuwellis' Aquadex system. And for Nuwellis, this number just went through the roof. Seriously, just look at the jump on this chart. The old reimbursement rate for using their Aquadex machine in an outpatient clinic was a little over $400. The new rate? It's over $1,600. It literally quadrupled, almost overnight. That is a massive, massive change.
And this changes everything. It completely transforms the economics of their main product. Before, it was a niche tool mostly used in hospitals. Now, it could become a super profitable, high-volume therapy for outpatient clinics. All of a sudden, the math for doctors and clinics to use this device just got a whole lot better.
And here's the little piece of evidence that this might work. Even while that backorder was crushing their main business lines, look at pediatrics. It grew by 23%. This was a critical sign that where the product was actually available, the demand was there. And it wasn't just there, it was growing. So, when you put it all together, you can see why the market kind of just shrugged off that horrible quarter. It wasn't about approving the bad results. It was a wait-and-see vote of confidence, a bet that this new, leaner strategy, plus that game-changing reimbursement rate, might actually be the recipe for a turnaround.
So, what are investors watching for now? Well, they need to see the proof. They're watching to see if the company can turn those outpatient trials into real, consistent sales. They need to see if profit margins get better now that manufacturing is outsourced. And most of all, they need to see a clear line of sight to this company actually making money.
But let's not sugarcoat it. The stakes here are sky high. Over the last year, the rest of the medical device industry did pretty well, up about 10%. Nuwellis, its stock got completely wiped out, down more than 90%. That means management has zero, and I mean zero room for error.
Which leaves us with the big multi-million-dollar question. The bad news is out, the new strategy is in play. But is this the beginning of a brilliant turnaround story, or is management just kicking the can down the road and buying themselves a little more time? Honestly, only the next few quarters are going to give us the real answer.